Welcome to Money Talks. My name is Mike Campbell, and I am glad you're with me. You know, in a minute, I'm going to talk about a brutal forecast about Canada's economy. Now, you can decide if you care. And also looking forward to chatting with Big Picture Trading's Patrick Ceresna about the latest on interest rates and what the heck is up with gold. And in case you missed it, the finance minister gave the economic update this week. Michael Levy's going to talk about it, along with the reaction to the latest Omicron travel restrictions. Plus, we're going to have the installment of Tax the Rich. Do they pay their fair share in our shocking stat? This time I'm talking about Elon Musk. Come on, he sold $14 billion worth of Tesla. Well, how much tax will he pay? And if you're a taxpayer, don't miss the Goofy Award. Plus, I'll be joined by Victor and Ozzy. But first, just over a week after Canada's Commissioner of the Environment stated that our record when it came to reducing emissions was the worst in the G7, we now have the Organization for Economic Cooperation and Development, the OECD, forecasting that Canada is going to have the worst economic growth among the world's 35 advanced nations over the next 10 years. And there was nothing in this week's financial update from the finance minister to suggest that they're wrong. I mean, the government's own forecast calls for under 2% growth between 2023 and 2026. And just so you know, 2% growth is not enough to sustain social programs like old age security and healthcare, let alone the raft of promises that were made during the fall election campaign. And by the way, I got to just tell you, this is where it gets tricky for me, because the evidence is overwhelming that while Canadians do care about the cost of living, jobs, and social programs, they don't seem to make the connection to economic growth. I mean, it shouldn't matter where you put yourself in the political spectrum. Economic growth is a key to so many issues. I mean, obvious ones like poverty or job creation, but to the protection of the social safety net. As famed economist Thomas Sowell states, you can't redistribute income without first earning it, and earning it's a heck of a lot easier in a strong economy. Although in today's world of record government borrowing to finance spending, maybe people will disagree. If you need something, you just print up more money. But nonetheless, I kind of suspect that Mr. Sowell's observation is going to hold true. Either that or the currency is going to be remarkably devalued and our standard of living is going to drop along with the buying power of the loonie. But just as noteworthy, with the OECD's projection that we're going to be dead last in the next 10 years, they went further. They said we're going to be the worst performing economy among advanced nations between 2030 and 2060. Now, come on, I would have thought that would merit some headlines or some intense media coverage, but it didn't. Didn't make any of the newscasts I heard or saw. Heck, the government's financial update this week didn't get much attention. And you might remember this, during the federal election, there was very little attention paid to the fact, as Philip Cross, former chief economist with StatScan, stated, Canada's 10-year average of 1.5% growth in real economic growth is the worst since the Great Depression. Now, and think about this one too, there were no questions about Canada's economic performance during the leaders' debate. As Alex Usher, he's the president of Higher Education Strategy Associates, points out, politically, there is no longer a political home for growth-oriented policies in Canada. No policies to increase collective wealth, to make the economy richer, more productive, more able to support higher private sector salaries and higher public sector spending. Nowhere to be seen. So, come on, let's not be surprised at the OECD forecast. Although, come on, dead last in economic performance is a bit of an attention getter, at least for me. But we've been ignoring warnings about the failure to focus on economic growth for years. I mean, former head of the Bank of Canada, David Dodge, observed, the policies of government in power and the proclivities of the current prime minister are not particularly oriented toward the hard work of generating economic growth. And that can make things difficult for the Department of Finance. Since 2015, there's been a massive drop in capital investment and investing in things like machinery, equipment, buildings, intellectual property. The OECD points out in their report, From the Chronic to Acute, Canada's Investment Crisis. Well, they point out that lower capital investment directly results in, of course, lower economic growth, but less innovation. And here's the thing that might concern you, lower wages, less government revenue, while at the same time raises the risk of the debt buildup. I mean, University of Waterloo economist Joe Blitt stated a 5-year decline in capital investment and exodus of capital should have rung major alarm bells, but doesn't seem to. Hey, how about this for a stat? In the 12 months ending September 2021, Canadian pension funds bought 130 billion in foreign equities, a record outflow of capital. As Stéphane Marion, he's the chief economist, National Bank Financial, says, clearly we are not doing well when our own domestic pension funds prefer to invest heavily abroad rather than in Canada. I'm not going to keep going on, but I want to give you one other, because it's not just capital investment, it's the lack of productivity growth. But think about this. Canada's R&D expenditure as a share of GDP fell from 2% in 2005 to 1.5% in 2019. Business R&D has also fallen sharply from 1.1% to 0.8%. Now compare that, though, with the U.S., same period. U.S. research and development development expenditures grew from 2.5% to 3.1% of their economy. That's twice as high as Canada. So as I said, no one should be surprised. I mean, clearly there are other priorities for the government, like climate change or social justice. All I'm saying is no one should be surprised that low capital investment, low expenditures in research and development, along with a heaping helping of anti-business sentiment, come on, that's a proven recipe for weak economic growth. I mean, we are going to get the economy, the poverty, the financial pressures on social services, the lack of money for new programs, and the stress of handling the massive debt increase, along with low wage growth and reduced job opportunities we deserve. We're going to get it. But one final thought, you know what? Our children, our grandchildren don't deserve it. We have a responsibility and we're failing them. If things don't change, their financial future will be far bleaker. And you know what? It seems like most Canadians seem aware of that. A Maru Blue poll released in the summer found that 68% of Canadians think their kids are going to be worse off financially. Only 27% think they're going to be better off. Well, I don't even know how the 27% come to that conclusion, because there's no evidence to support it. Hey, just a reminder, this is our last show before Christmas. We're taking the Christmas week off, but I'll be posting like crazy on Mike's Money Talks on Facebook, on Money Talks tweets. But also, we'll be back. We're going to do a year in review and a looking forward to 222 show. We'll release that on December 29th. So mark that down in your calendar. Well, this week, as you know, we had a fiscal update. I want to get Michael Levy's take on that and bring him in right now. Mike, let me just start with what was your take when you heard it?
I said, what fiscal update? That was absolutely a non-event, Mike. Something the government's been leading up to. They come out with it, and you turn around and you say, what? What update?
Well, first of all, that's the way I felt about the throne speech in September 2020. I felt about the fiscal update in November 2020. Why are you saying that now?
Mike, I think the government was going to come out with a pretty detailed fiscal update. I know they were looking at an extra tax on the banks and financial institutions. They were looking at all the money they were going to spend from the excess revenue they got in because business was so good. People are paying more taxes. And all of a sudden, they come out that day. I think the overriding deal is Omicron. And they don't know what's going to be happening next year. Because if they go through this whole litany and slap a tax on the banks, slap a tax on financial institutions, raising taxes otherwise, maybe a wealth tax, maybe raising the capital gains tax, and our economy takes a downward turn, which it very well could with the new variant, I think they just backed off. And if you'll pardon my expression, I think they just chickened out.
Well, I mean, one of the things I think people were looking for is some of those campaign promises, what was about $50 billion in stimulus. They didn't see that in this fiscal update. The other thing I'd throw out at that, Mike, and add to your list is inflation. I think clearly the Bank of Canada, clearly the federal government has been surprised by the persistence of inflation. And now we see reports suggesting that it's going to be with us longer. We'll have, another debate will now ensue about how much longer, 6 months, is it 9, is it a year? But fiscal stimulus in that environment also is problematic. So, I want to come back to something that I know you follow very closely, is the reaction of the banking industry to this.
They usually are mum when the Department of Finance comes out with significant changes. But Dave McKay, he's CEO of the Royal Bank, he was really, really critical of the feds with this new tax. He said it's going to make it much harder to attract the much needed capital to help finance transition in Canada's economy, which is surely coming. And this is important, Mike. When you start proposing taxes right now in this narrow way, it can be a real detriment to the overall investment thesis for Canada. A tax on banks, a unique tax like that, means less capital for small business, less capital for investment in our clients. And it really, really puts a damper on investment in Canada, investment with the Canadian banks. But also what was unstated, Mike, you and I have been talking about this for so long, is the tax hike would have also meant less dividends for shareholders because you're attacking profits, for less dividends for pension funds, mutual funds, retirement savings. It's not just the banks. That rise in profits, tax on profits over $1 billion would impact just about every Canadian.
Yeah, and it's a difficult environment. I don't want to pretend that it's easy, although I think a lot of people, you just alluded to the lack of capital investment. I mean, we're at a generational low. That is the foundation of economic growth. So it's troubling, I think, for many people. We haven't still had a clear plan. How are we going to attract capital, let alone putting in measures that may discourage it? But I want to come to one other thing too, Mike, before I let you go, and that's, it is not an easy environment to project what the economic growth numbers are. And I do appreciate that. And Omicron is just the latest example. But I mean, let's look at the travel industry and the level of uncertainty that's now gripped the travel industry because of, the advisory not to non-essential travel.
Mike, if there's a safe industry within the Western world and probably the whole world, it's been the incidence of infections while traveling, particularly and I'm going to say by airline, never mind particularly, there are just literally no infections as when people travel that way. And they've come out with this travel advisory. It's going to hurt the airlines so badly. And the question asked by the new CEO or the interim CEO of WestJet is, where's the science? Share the science, share the data with us when you're going to come out with a mandate like this that's so stringent, that can be so harmful for a staggering airline industry anyways. Open it up and tell us about it.
Well, he's certainly not the first one in whatever regard it was to ask for the data, ask for the research that's behind some of the restrictions. But in this case, as you say, it's an industry that has barely been in recovery mode, obviously, only 2 months, you might say, when restrictions have been lifted, recently for, of course, easy cross-border travel or easier cross-border travel. So you can certainly see their concern if you add on new restrictions. And I don't think it's an unreasonable thing for the head of a major airline to say, hey, can you show me the rationale? Can you give me the research to explain why? So, sorry, go ahead.
Well, the knockover effect is going to be, it's not just the airline industry, it's the travel industry, it's the tourism industry, it's all those jobs, those so important jobs in hotels, in restaurants. This is not just hitting the airline or hitting people who would want to travel domestically, US and Canada, just Canada. But I mean, the effect on the whole industry, that's a huge economic hit again. And I don't think the government has even remotely properly looked at it.
Well, we're obviously going to be chronicling this. Maybe a good time to take a break. This is a depressing show. My goodness gracious. Just join Mike Campbell in Money Talks and it'll ruin your day. Like a serious subject, especially for an industry that's been so hard hit and the people working within it so hard hit. This is just another knock on, full headshot that they can't afford. But in the meantime, Mike, as I said, we are not doing a Christmas Day show. What we'll do is we'll get back December 29th, I think we're doing, and we will have a year in review New Year's show featuring you, featuring Ozzy, featuring James Thorne, Victor Adair, of course, all of that to look forward to. In the meantime, happy holidays, Mike.
Well, Mike, and same to you and same to your family. Have a really great Christmas. Enjoy the grandchildren, kids, grandchildren, and we'll talk to you for the 29th.
Time now for the quote of the week, and it comes from British historian David Starkey. He stated this on the BBC. In the last 20 years, we've had a revolution by stealth, not in our streets, but in our values as a generation brought up with no rules and no religion has lurched with quasi-religious fervor into a puritanical groupthink where debate is stifled and difference of opinion cannot be tolerated. In politics, too, there is a new pseudo-religious intensity. You could have been pro-Trump or anti-Trump, Remainer or Brexiteer, and confront each other in a sort of holy war. Come on, it's not hard to think of so many debates in our country, whether you're talking pipelines or climate change, now even, I think, vaccine mandates in this context. But then he goes on to warn in quotes, "This does not bode well. Last time that religion so dominated politics was in the Puritan religion, which led to civil war, the abolition of parliament, and military dictatorship." End of quote. Hey, just a reminder, the Christmas week and the holiday week into New Year's, I'm going to be posting a heck of a lot of quotes from the year, some terrific quotes that are only designed to make you think, to give you a different perspective, some well-known people, some experts over history. So I will be doing that. And a reminder that we will not be doing a Christmas Day show, but we will be back in the following week, December 29th, where we do our year in review and our look forward with everyone, including Jim Thorne. So it's going to be a great show. So put that on your calendar. Been looking forward to this chance to have an opportunity to talk to Patrick Ceresna, big picture trading. But I also listened to Patrick on the Market Huddle with Kevin Muir, who we featured here a few weeks ago. I adore Kevin. Macro Voices, he does a great podcast. So he's got a full day, and I appreciate him finding time here for us. Patrick, can I just start and throw something at you very quickly here? Because we've got the Fed came out this week. Everybody's watching what the Federal Reserve is going to do. Are we raising interest rates? Is the taper moving up? You know, we've got inflation. All of those subjects seem to be the dominant subject right now if you listen to market discussion.
Yeah, the FOMC is one of the more interesting subjects. And certainly the one thing that I kind of look at much bigger picture is that much of the bull market has been driven by a very large inflow of liquidity into this marketplace. When you had such a key shutdown of the global economy to fight Corona, the way that both the fiscal and monetary response was, we got to get lots of money working in there to balance out the economy from this forced shutdown. And right now, what we're seeing is the central banks around the world have coordinated into basically taking the punch bowl away from this great party that's been driving the stock market higher. And it's really interesting because on the way up, we had this big inflow of money and driving the prices, and now everyone's getting worried as to whether or not the Fed is going to go too far, taper too much, cause some sort of a market response. And that certainly has to be on everyone's mind. Now, the one thing that is worth noting is that doesn't necessarily make it an immediate risk. The market could sustain 4 rate hikes over the course of the entire next year before the market has a response to it. So this is not like red alert. It's January. The markets are going to be at high risk, but the asymmetry of the market is poor in a sense that so many of those really big stocks and indices have run so far and so high that maybe there's a 5% upside on the market, but at some point, the chances of the stock market reacting to a tightening central bank may lead to some sort of a risk event next year, and certainly something that I'm watching.
Well, one of the things I know you've been discussing, we certainly have here in Money Talks, is that how this market, at least when you're watching the indexes, it's been so driven by about 8 stocks.
Yes.
And, when we've watched major corrections in some areas that I'm interested in, and we've, as you mentioned, tax loss selling as we come into the end of the year in the U.S. markets, you can go right through December 31st and get a tax loss. But it's not been as rosy a picture as the market near all-time highs would suggest.
Oh, you are bang on, Michael. What we've seen was that you had to be in the FANG stocks essentially in order to be getting any legitimate performance. It's one of those scenarios where many people are holding a basket of stocks, and then they see the S&P 500 making, approaching its 52-week high, and they look at their portfolio and say, "Why is my portfolio doing nothing?" Or why am I down 5 or 10% when the market is doing this? And that's because unless you're indexed or you own those basket of stocks, you have been dragging on your performance. But it's also really interesting if you look at the sectors over the last month that have actually performed. The utilities, consumer defensive stocks, REITs, healthcare stocks have started to come back. All the defensive sectors, the bond proxies, all those things that typically are moving when they're defensive. If you've been in the industrials and the energy and broader technology, that's not the FANG stocks, consumer cyclicals, they've just had an awful month. And the thing is that those were the most popular sectors in going into the fourth quarter of the year. And so many investors that were positioned in all of those darling stocks in those cyclical sectors suddenly are like, why am I not making any money in this environment? And that really is such an interesting story in terms of the way the market is responding. When we have historically, or at least decade high inflation numbers or multi-decade high inflation numbers, one would think that bonds would be doing poorly and interest rates would be going higher. And yet we are seeing that those treasury bonds and yields continue to stay incredibly low and even going lower with yield curve flattening and all sorts of things going on. Those bond proxies stocks are suddenly attractive. And it's a bizarro world in terms of of where we are on that. And one of the big things to watch into the new year is that a sustained trend? Will we continue to see those bond proxy defensive high dividend paying sectors outperform, or is this just noise and that we're going to see a lot of things go back to normal in the new year? Certainly was something that's on my mind.
Do you think it's because people are some major pools of capital are getting more defensive right now? Maybe it's an easy thing to say, but maybe it's the restrictions that continue to be enhanced with Omicron. I'm just giving one example, and that's oversimplification of it. But I think the move, as you say, has been to a more defensive position, which to me would indicate people, at the very least, are going to a wait and see kind of attitude.
You're absolutely right. And so when you are an asset manager and you don't have the choice of raising cash, the most common thing is to reweight your betas, and you're going to go and go from a far more aggressive positioned high beta security to the lower beta security of high dividend paying, less volatile sectors. And some underpinning rotation is almost certainly happening. But one of the interesting things you alluded to earlier in the conversation about tax loss window, what is interesting is that we continue to see into the year end here, those things that have been doing very poorly continue to do poorly, as those are the sectors that typically will be abandoned for tax loss purposes. And the sectors that have done incredibly well, particularly those FANG stocks, are holding up very, very well into the year end because many people may be attempting to defer the sale of the underlying security into the next tax year. Certainly one of the things that I'm going to be looking for is, does the new year suddenly bring a rotation in that, where all of those things that have been left for dead and beaten down, particularly sectors like golds and things like that, will they suddenly have a resurgence in what is typically even a seasonal rally that tends to happen in the first quarter of a year?
Just a couple of things. And I'm just thinking in terms of when you said, the Fed is trying to manage us for sure. They don't want that reaction they got in the fourth quarter of 2018 when they started to talk about raising rates a little bit and the market dropped like 20% almost instantly. At least it felt that way. And they don't want a repeat of that. So they're sort of managing our expectations. And I thought that's what this past week's meeting was about. Like, hey, get ready. Maybe we'll get 3 increases. And I'm with you. The market can certainly absorb that. I mean, what? I'm going to stop my economic activity because now I'm playing 0.75% instead of 0. I don't see that. But it's just fascinating to see the degree to which my guess is they're looking back at that December or, sort of November, December 2018 period going, we don't want a repeat of that. So they're really kind of messaging us to death here.
No, that they are. But, the one thing, though, that what I look at from a perspective of markets and liquidity and flow, the thing is that, you're absolutely right that three rate hikes would not necessarily change someone's decision economically in terms of whether or not they're going to get a mortgage or finance a business project or something like this. But one thing, though, it does influence is traders that are looking at rates of change and direction of the way that the central banks are behaving to determine whether or not the stock markets as an aggregate will be getting flows in or out. And at minimum, the tightening of conditions changes the asymmetry of the payoff, which is the stock market lost that extra kind of booster shot, that adrenaline that drives those outperformance on the upside, and it's being taken away, which basically means it will be harder and harder to find returns in the stock market. Doesn't mean it can't go up, but it's just not going to be easy money anymore. There's that kind of off that March low, the fact that the S&P is 100 and some odd % up in a year and a half is those easy gain periods are now gone, and it's going to be a much more normalized return if the markets do keep going higher.
Let me come to one aspect there that sort of puzzled a little people, and that has been the performance of gold. And yes. I say puzzled for a couple of reasons. One is there's sort of a simplistic relationship that many people believe you create this much money, both fiscal and monetary policy, very supportive that way. So hence gold should go up. That's one. The other is in times of uncertainty, gold should go up. And we really haven't, sure, we got some nice boosts the last couple of days, but that's nothing. That's not the long-term bull market that we've seen in other things. So what's your take on gold at this point?
I look at gold very cyclically, in a sense that everyone's always trying to make these really big picture calls that, the dollar's going to fail and you need gold. And there's all these different narratives that come around and gold is dead and that, crypto is going to take it over. I don't buy any of that stuff. I look at gold as a core portfolio asset, and it moves very cyclically. And one thing that I track is the bullish percentage indexes, which is, let's say, a very good tracker of the sentiment towards gold. And we have seen over and over again over the last decade, gold go from incredibly negative sentiment to incredible bullish sentiment. And the markets go through these boom bust cycles, and gold is just so cyclical in those manners. We now have reached negative sentiment to the degree that we have seen previous bottoms in gold. Most people are incredibly negative. A lot of people I talk to are just like, don't want to hear about it, or thinking of selling it because it just hasn't been doing anything. And often some of the really best buying opportunities occur when that kind of negative sentiment exists. Now, what we saw was a relatively still hawkish Fed, but yet gold and silver responded with at least a short-term rally off of their lows. It'll be really interesting to see if all the tax loss selling pressure in the gold miners that has been arguably underway, whether things shift in January. It's going to take a little bit of work for these charts to turn bullish. I wouldn't want to be already kind of pounding the table long, but if we see proper price development in there, there's an extraordinary opportunity. Of the last 9 cycles in gold miners that I've tracked, the average rally in the miners off of one of the cycle lows and a subsequent rally that follows that usually takes about 10 months has averaged almost 100% return off of the lows. And of course, the bust cycles are these 30 to 40% declines during these corrective periods. And so with the magnitude and the depth of this correction in gold, it's starting to look asymmetric to me. I think at some point there's going to be money made, and the sentiment always shifts. You know when, Michael? You know this more than anyone else, which is as soon as it starts going up. When people start seeing money being made in gold, suddenly everyone's like this negative sentiment toward gold suddenly shifts quickly, and it's like, oh, I'm missing out. And then the FOMO kicks in, and suddenly everyone's chasing it. And sometimes it's good to be a little bit early to the story when no one cares about it.
And I hope people listen clearly there. Now, obviously, everybody's got to decide, am I a trader and what's my time frame? Am I a longer term investor? But for longer term investors, one of the things I've been saying is exactly that, Patrick, is, decide what position you want and take at least a part of it or, right now, because when it starts moving, look around all the other markets. Once it starts getting popular, I'm so with you. There seems to be a stampede in, and then it gets hard. A lot of times psychologically, it's very difficult to get in when you've when it's moved 25%, all of a sudden, you sort of, well, if it comes back, I'll get in. Well, that doesn't seem to happen. I've certainly made that mistake numerous times. But so I'm really with you, and I'm glad people get a chance to hear that. I think excuse me, if you're an investor, I'm not talking trader for a second. If you're an investor, get a position, because once it starts to go, I'm with Patrick, it goes quickly. So interesting in that. Can I just flip also? I know time's short, but I've got to get a couple more things in here, and give me a quick take on oil and what's been going on. We've been following that natural gas story in Europe up, whatever hundreds of percent. The coal story. We had the International Energy Agency tell us yesterday it's going to be a record demand for coal in 2021 and 2022. Where are you at with oil?
In the bigger picture, I remain quite bullish oil. I still think that the case is to be made that there isn't enough infrastructure being put in and enough capex going in to maintain what will be still a structurally high demand for oil for a decade or more to come. So overall, I think there's lots of room for oil to even in the years to come be well over 100. But what was happening a month or two ago was everyone was, it's the exact opposite of gold. Everyone was so bullish on oil, that everyone leveraged up, everyone was all in. And what we witnessed in the oil market was a liquidity event, which is one big margin call, particularly in the futures market. And it had nothing to do with the fundamentals. Fundamentals, I always say to my members, fundamentals matter over the long term, but over the short to intermediate time frame, it's all about liquidity. And when people are being forced to sell, the fundamentals don't matter. It's about where the bid is and how many people need to sell and what the conditions are. And what we saw there was one big washout in oil, where, $20+ in a very short window of time. I feel comfortable. I've been saying for weeks that probably was the intermediate low. Now, in some cases, if the market is weak over the next couple of weeks, oil could go and retest those lows or establish a base from which it will. But overall, I think that now that it's been reset, it's once again time to revisit the opportunities in the oil markets.
And last one is because I just want to pick your brain. You talk to a ton of people in the analytical field. What would you say it's sort of like a baseball score, and this and $2 gets you a Starbucks coffee, but I'm still interested. What would you say the percentage of analysts, and as I say, you have a huge cross section that you're familiar with, are inflation guys or short-term inflation guys? Obviously there's inflation when you get 6+%, but what would you say?
Secular versus the transitory kind of view like that, right? What's interesting is that first of all, the deflation camp is very small. You can count them on your hands in terms of how many people are out there on a deflation camp. But generally, there are very large I would say a 2 to 3 ratio, of people that are in the secular camp, which is that this is a much bigger picture view. But I am not so sure. Because typically a sustained long-term inflation has the characteristic of a large expansion of money supply, and this really seems like more of a supply shock and commodity shortage kind of inflation, which is not long-term sustainable. And therefore, while the inflation is here, I'm not so sure I see the signs that this is going to sustain. I'm in that camp anyway.
Well, it's going to be obviously a key thing because people just go straight down to what are things costing me? And as you say, the supply chain problems. I again posted something yesterday that showed that we got an all-time record of ships waiting outside the LA Long Beach harbor. I love the way, by the way, Patrick, they put them over the horizon so they didn't have to get counted. I love government. But that, that's part of it. And that'll be part of the ongoing discussion, as we started with, what's the Fed going to do? Are there going to be 3 rate increases, 1, 9, whatever it is? And people can go to bigpicturetrading.com, bigpicturetrading.com, get the latest from Patrick, or go and listen every week to Macro Voices or Market Huddle with our friend Kevin Muir. So lots to do. And it's the kind of environment that's incredibly interesting. We'll keep up with it. And in the meantime, Patrick, appreciate you taking the time, and I wish you a really Merry Christmas to you and your family.
Well, thank you very much, Michael. It's always a pleasure coming on your show, and happy holidays to you and the team.
Thank you.
Thank you.
Time now for the shocking stat of the week. And this one is a shocker. I mean, taxing the rich has always been a popular subject, but I kind of noticed, especially since the Occupy movement vilified the top 1% of income earners, it was about 10 years ago. Of course, the antecedents go much deeper. I mean, Jean-Jacques Rousseau famously said, when the people have nothing more to eat, they'll eat the rich. Well, that became the battle cry for the French Revolution and many times beyond. You see it on T-shirts right now. The familiar cry of the rich aren't paying their fair share of taxes. I mean, come on, it's the rallying cry of the left-wing politicians everywhere. Just this week, Democratic Senator Elizabeth Warren demanded Elon Musk to, in quotes, actually pay taxes and stop freeloading off of everyone else. By the way, to which Musk replied, "Please don't call the manager on me, Senator Karen." But this is the context for today's shocking stat. So much of the focus is on the new billionaires of technology, but arguably the biggest spotlight is reserved for Elon Musk. I mean, we could be talking Tesla, SpaceX, Neuralink, OpenAI, Bitcoin, other cryptocurrencies. Well, recently, after consulting his 65 million Twitter followers, he was asking about whether he should sell part of his massive stake in Tesla. Well, he's got a yes, so he started to sell his stakes with the goal of selling up to 10%. Now, to date, it's estimated, including this past week, he sold $900 million worth, but he's sold somewhere close to $14 billion worth of stock, which is, getting up to around 4% of his holdings. Now, fast forward to Tuesday, when Musk waded into the debate about whether he pays his fair share of taxes by tweeting that he would pay more taxes this year than any American in history. Now, that's tough to verify, but many analysts kind of think he may have a point. Like many other well-known entrepreneurs, the CEOs, he doesn't take a salary, by the way. His remuneration is in stock and options. So if the company does well, stock rises, which obviously it has with Tesla, his compensation goes up. So let's get to what his estimated tax bill is. Now, despite leaving high tax California for lower tax Texas, he did that personally before the company did. The estimates are that he'll still pay over 50% in tax on the sale of his shares. Now, maybe he could mitigate that if he's got losses in other businesses like SpaceX, but right now, let's just take it at that. Forbes magazines estimate that Musk's tax bill will be north of around 8.5 billion US. Could go higher, by the way, if he sells more auctions, because options in the US are treated like income. Or, of course, it would go higher if he sells more stock, but that's capital gains. But 8.5 billion. Now, is that enough? Well, it's never enough for some people and more than enough according to others. Either way, come on. $8.5 billion in tax. That's a shocking amount of money. And just a reminder, this one isn't a shocking amount of money. I just want to again remind you that if you're still looking for a Christmas gift and you are tired of giving the same old, you're giving to people who, hey, I mean, they just don't need another X, Y, or Z. What about a ticket to the World Outlook Conference? I really encourage you to consider that all you have to do is go to mikesmoneytalks.ca, go to the events page and book your ticket. February 5th and 6th. It's all online, so you can access it and then access it again if you want a review of different things. Obviously, I think you should be going, but hey, it is a good idea for a Christmas gift, something a little bit different. Go to mikesmoneytalks.ca. I want to come back to the fiscal update that we got this past week, but this time I want to focus just on the real estate side of things because, as usual, governments, no matter what the stripe, no matter what the level, always talk about affordable housing. And they forget to tell us that, as I've mentioned earlier, they're one of the big reasons we don't have affordable housing. But I wanted to get Ozzie Jurek in here. Mike, we had the finance minister saying it's going to take years to tackle the challenges of Canada's housing market. And of course, she's talking about unaffordability. So I just wanted your take when you hear that kind of stuff.
Well, I don't think anybody disagrees with what the government says. We want more housing. We want more affordable housing. But that's where it's at. It's a big statement. Mr. Askari, as part of the press release, said that supply is the only part that we can do something about. I disagree with that. We can't do anything about it because we can't get the governments together. And there's some other things that we actually need to fix. And somebody sort of with a Gordian sword cut through all the BS on all the three levels of government, because none of the governments will do anything that might affect themselves, and yet everything that they would decide in this would have an effect on the other level of government.
I'm not trying to jump all over the finance minister for this because, as I say, every party talks about it. She says addressing the issues of housing affordability is a priority. I mean, really, how long have we been hearing that again from various parties, various levels of government? And obviously, it hasn't worked. Just the words do it. It's a great example for me, Ozzie, of the sort of virtue signaling, saying the right thing, but not following up with real specific actions that can make a difference here. And in fact, they're working against it in so many areas that we can go into. I mean, one of the things that jumps out on me is that we still have to find homes for 1.2 million immigrants coming in the next 3 years. People coming from other countries. And, obviously they're going to settle in probably the main areas of, Toronto, Montreal, Vancouver, Hamilton, maybe, and other places, of course. But again, that alone, you sort of go, well, what's your housing strategy to help those people find a place? Well, there isn't one.
Well, and you're so right. It is, and it isn't just the immigrants. It's the schooling, the students that are coming back, several 100,000. Everybody needs accommodation. What I look at is what exactly the press release says. For instance, the statement that we need more Crown land. Well, what the heck does that mean, Crown land? I mean, the land that's owned by the Crown likely is not going to be in downtown Vancouver or anywhere near the city. And then who owns it? Is it the province that would make it available? Or is it the federal government that makes it available? It's just one of those easy, we'll make it available for developers to get easier Crown land. Maybe it can affect in maybe some outer town area, but likely that's not a solution by itself.
But, and I'm not suggesting, and I know you aren't, that this is something easy, but we really have had decades of this conversation, especially in those centers like Toronto and Vancouver. And, it hasn't produced the kind of results I think anybody's happy with when you look at it. But so much of it is government policy. If you want to bring real estate prices down, it's simple. Let interest rates return to the norm. And as we've chronicled in this show correctly, from the get-go of the pandemic, the record low manipulated interest rates translating to record low mortgage rates is the number one driver. There's other things, but it wasn't foreigners coming in. We didn't have foreigners coming in. It wasn't that kind of a rationale or a variable. It was directly that we had record low interest rates, and they're still going to be with us for a bit.
Well, and you're right. And the thing is, I'm not blaming local government. Look, the city has to have an official community plan that lays out the future growth of a city. And currently they have certain areas that are earmarked for commercial development or rezone the neighborhoods. But if you did rezone the neighborhoods, how do you force the owners to allow, say, 6 units on a lot? For instance, we have a great architect in Vancouver, and Michael Geller, who has actually his Christmas card is a whole bunch of solutions of what you could do on one city lot, maybe 6 units. But then the problem is, well, you might lose your capital gain exemption if I actually did that. Or the whole neighborhood in Kerrisdale, how would you like to have a Kerrisdale residence worth $3 million and you put a fourplex or fiveplex? You have to simply get all of the participants together and saying, okay, this is the new road and this is why we're going to do it, and advertise it to the public.
And again, there's always a timing issue too. Can you imagine the sort of procedures you'd have to go through to have a radical change in density in a single family neighborhood, which for most of Canada is what the solution is here. So, I mean, it's just, I just found it far too glib for my liking. And it was typical. And this is why we haven't made progress. So I want to come back to something you just said. If you had a gun, what would you do to create at least the road to significant solutions here?
Yeah, so first of all, you realize that all the governments act in isolation now. The BC government charges a speculation tax, even if your strata council will not allow rentals. You haven't got a choice. You can't rent it even if you want to. Doesn't matter, I want the tax. The city needs a 36% increase in property taxes over the last 5 years, and we need that in order to run it. So if you put them all in one room, a representative of each government, plus maybe a developer, plus people like Michael Geller, and give one of them the power to overrule everybody. They won't be able to leave that room for, say, a week or 2 weeks until they have a solution. The city must find or rezone the land somewhere for 50,000 units, freeze the property tax on it, or the city has to exchange the zoning on it to allow multi-use, but maybe have an ad campaign with it to give it to the population. Delete the provincial taxes on that land, maybe freeze it. Maybe freeze the capital gains tax. So you say to the ownership, look, all your capital gains, free capital gains tax is frozen as of today. And from here on in, if you build a laneway house or if you build a 6-unit on your property, you won't lose that capital gain exemption. And then maybe give special incentives to developers. But something has to be done together, because otherwise it's like putting 4 horses on a cart and they're all pulling a different direction.
Well, it'll give us lots to talk about in the new year. Ozzy, thanks for taking the time. And in the meantime, I want to wish you a Merry Christmas to you and your family. And we'll be back with our year in review, New Year special coming up after Christmas.
Yes, Michael, and I wish the very best to all the listeners as well. And I'm with Woody Allen, by the way, who said, I don't want to achieve immortality through my work. I want to achieve it through not dying.
There you go. We'll be back. I still have a Goofy Award. I still have Victor Adair. There's much more coming your way. I'm glad you're with us on the Money Talks podcast. Let's go live to the trading desk. I got Victor Adair on the line with me. Hey, Vic, I want to start with, the Federal Reserve had their big announcement during the week. What did you make of it? What should we have as a takeaway?
Interestingly, Mike, the way the Fed came out with what they voted to do and in the press conference was probably as hawkish as the market was expecting. They are certainly going to accelerate what they call their taper. In other words, going to buy fewer and fewer bonds and mortgages. And they voted that if the economy stays strong and if inflation stays strong, they may raise interest rates as much as 3 times next year. So I think that was really at the margin of how bullish or hawkish, let's call it, the Fed could have been. And yet the market just took off like a scalded cat to the upside. But the market, I mean, the stock market, it was, and we just had such incredible volatility here this week, also with a big option expiry on Friday added to that. But, there's one other thing here, and that is politics. It looks as though Joe Biden is just not going to be able to get the stimulus package through. And that's going to be very important as well. And maybe, something we can talk about in more detail in the future. But the, one little tidbit out there is student loans. And during the COVID period, people didn't have to pay those student loans. Now, beginning in February, they're going to have to. There's something like, off the top of my head, several millions of Americans that owe student loans yet, and the total amount of money is just short of $2 trillion. So that's going to be, let's say, a real wild card as we go into next year.
Well, we're going to talk about that in the Year in Review show coming up next week. Of course, we're not doing a show for Christmas, as I mentioned. We will go through to next week, and we'll put it on. I think we're going to do it. It'll be available starting on December 29th. We'll do our year-end show, and there's much more to talk about. But I want to come to one other aspect here, Vic, and that's there's a ton of cash on the sidelines. But what I find fascinating is what's the message there?
There's trillions of dollars in cash. And I think the sort of mainstream view is that that's just scared money that's just too nervous to plunge into the market. But that money will have to come into the market and goose the stock market even higher. I think that's kind of the mainstream consensus view. I take a little different view. I wonder if a lot of that money, and it's going to be largely wealthier people, okay, who can afford to just have cash sitting on the sidelines, doing nothing with it. I think they look at the stock market and see the stock market has got a lot of risk in it here. And they're comfortable to just sit on the sidelines, and they're not going to dump all of that money into the stock market. Something that kind of goes along with that has been the bond market is getting a lot of cash flow into it. I mean, the yields on 10-year treasury bonds are 1.5%. People obviously aren't dumping money into the bond market because 1.5% looks like a terrific deal. I just think it's money looking for relative safety here. And that's just, I guess my point, Mike, is if you're counting on that wall of money to come in and take the stock market a lot higher, you might want to think about that twice.
Well, and the other thing I'm looking at is very quickly here is that, big tech is the one who's been taking it on the chin. And as we've been discussed with Kevin Muir, you and I have been discussing it. That's the dominant aspect of the market. I mean, whether it's Microsoft or, Alphabet, Apple, that kind of stuff, it's been absolutely the dominant part of the market. Well, it's starting to get hit. Should we be nervous about that? Or is that just another reason to sort of put that in our radar and go, you know what, we should pay a little attention there?
You could be nervous about it, or you should be nervous about it because it has been so important. There's been a handful, really, of big cap tech stocks that have been or have contributed most of the gains to the major indices this year. A lot of the smaller stocks have been not doing nearly as well. I think if you subtracted out the top 5 stocks from the S&P would be up about 6% on the year instead of 20-odd%. So if we have a situation here where some of the big cap stocks are starting to fall and the smaller stocks have already been weak, yeah, the market could, come off some. I think that some of the thinking I'm seeing that says here's why those stocks are coming down. They like really low interest rates. And if we look into the future and see interest rates rising, then that's bad news for big tech stocks. I take a little different view. In the business of managing people's money, there's a lot of folks that are doing that. And one of the things you really want to have to get more money under management is a great track record. So if you're a money manager and you've had these like Apple, Microsoft, that sort of thing, a big position in that this year, you might be selling some of that just to lock in a great track record. Because come January, that is typically the time when there's another wall of new money comes into the market, and they want to have their marketing materials out there to capture some of that.
Interesting point. Hey, Vic, you'll be with me next week for the Year in Review, the look forward on the show. In the meantime, I want to say have a very Merry Christmas to you and Gina.
Mike, thank you kindly, and I hope you and your family have a great Christmas as well as all of our listeners.
Got a goofy award for you. Stay with me. Time now for this week's Goofy Award. And for it, I return to a lonely subject, accountability in government spending. Come on, a subject which very few Canadians, virtually no politicians, seem to be interested in, no matter how many tax dollars or how much borrowing is involved. I mean, maybe there's not a need to go over the many Auditor General's reports. I get it. Chronicled massive wastes of funds like the Phoenix pay system. You know what? It actually paid bonuses to the bureaucrats involved, despite the fact that the system didn't work, at a cost overrun of hundreds of millions of dollars. I mean, how government spends our money has never been a campaign issue, no matter how many billions are involved. So, come on, why would it be any different when it comes to COVID spending? I mean, despite the fact that the abuse of the CERB system that was supposed to cost just over 24 billion ended up costing 82 billion. But here's the thing. Data showed that 8.9 million Canadians claimed CERB checks. That was despite the fact that the actual number of pandemic-related unemployed peaked at 1.485 million in May 2020. That's a big discrepancy. And despite the fact that fraud was identified just weeks into the launch of the program, but the CRA was told not to investigate. So here we are. This week we found out 20 months later that Canada Revenue Agency admits it still has not investigated a single case, which, by the way, conveniently prevents the Auditor General's office from investigating the effectiveness of the program. So as I said, are we surprised at all? Although for a government that's keen on being seen to do the right thing, some might call it virtue signaling, I am surprised that they don't even pay lip service of making sure tax dollars, especially those borrowed from our children, are spent in the most effective way possible. And that brings me to the specifics of this week's Goofy. As Blacklock's reporter notes, the Commons Ethics Committee voted by 6-4 to reject a motion, in quotes, to undertake a study into issues of conflict of interest and the Lobbying Act in relation to pandemic spending. So they rejected that idea. As the Prime Minister's Parliamentary Secretary, Greg Fergus, states, it would be just stirring the pot. Well, I bet it would be. Kind of stirring the pot like looking into the We Charity scandal or SNC-Lavalin or COVID contracts like the $237.3 million sole source contract, no competitive bid, that went to Montreal's Baylis Medical Company for ventilators. Now, it was operated by ex-Liberal MP Frank Baylis. Now, as I say, this was for ventilators, but here's the thing. Health Canada never requested them, and they were never used, $37 million. By the way, that same MP, well, now former MP, Mr. Baylis, voted to shut down the Ethics Committee's investigation into SNC-Lavalin. So in 2 years, the federal government has borrowed and spent $508 billion, the majority of it, though, without oversight. As a conflict of interest commissioner notes, right now, there are rules, government contracts for family in the conflict of interest code, but not for friends. Of course, the difficulty is how would you actually legally define the word friends? And I suspect a bigger problem is awarding contracts to government-friendly businesses, no matter which party's in power, and then they get a donation in return. I'm going to give the last word to Liberal MP Mark Garrison, who does not support conflict of interest, increasing the conflict of interest rules. He states, if someone wants to neglect to do what is right, in my opinion, they'll always find a way to do that. I say no kidding. And we have billions of dollars in questionable spending, even outright fraud, that proves him right. My prediction, nothing's going to change. That's all the time we have this week. And as I say, no Christmas week story. Of course, Christmas falls on Saturday. We'll be back with you on December 29th for a year in review. I hope you join us then. But in the meantime, I hope you have a wonderful holiday here. Enjoy, at least get a chance to enjoy the family and friends. Thanks for listening.
This is the Money Talks podcast with Michael Campbell, available at mikesmoneytalks.ca or through your favorite podcast subscription service. Join us on Facebook at Michael Campbell's Money Talks and on Twitter at Money Talks Tweet.